Hello everybody and welcome to another episode of Options Discovery on John Lothian News' The Spread. My name is Alex Teng, and just like many of you out there, I am no expert in the world of options, but with the help from some, we can learn more about options together. In this week's episode, we're going to be talking about algorithmic and automated trading. In order to do this, we're going to talk to Scott Morris, the Chief Investment Strategist at Blackthorne Capital Management. Scott has a long history with algorithmic and high-frequency trading, starting in the 1990s at Hull Trading, one of the first firms in the space. Now stay tuned for that interview in the second part of this episode to get that in-depth dive from Scott into algorithmic and automated trading. Now let's get into our primer. Alright, so let's start by introducing the concept of algorithmic trading. And let's start off with a question: what is algorithmic trading? Well, algorithmic trading is a term that is used loosely to describe automated, rules-based trading. This essentially means that a trader creates a system that executes trades based upon a set of pre-programmed rules. And algorithmic trading has a ton of different use cases, a few of them being liability trading, agency trading, and even market making. For mid to long-term investors, algorithms can aid in getting the best execution possible on an order. An example of this could be anything from a buy-side firm looking to trade as an agent to a fund trying to break up a large order. Algorithms can help determine what is the best way to execute an order that reduces the amount of market impact and slippage. Two very popular execution-style algorithms are TWAP, time-weighted average price, and VWAP, volume-weighted average price. Short-term traders also benefit immensely from algorithmic trading. And this is because algorithms can operate faster than any human and aren't prone to the same errors as manual trading. From arbitrageurs to market makers and hedge funds, algorithms are deployed to take advantage of opportunities that are only available at the highest trading speeds. Algorithms also play a big role in providing sufficient liquidity to the market, and many market makers in the options industry rely heavily on algorithms to run their business. So how do algorithms work and what is required to operate them? Well, in order to get into that, let's just start off with an example. Imagine we have a stock that's listed on two different exchanges. Now, because it's the same stock listed on both exchanges, the prices should be extremely highly correlated, if not the same. But at high enough speeds, sometimes a price discrepancy occurs and an arbitrage opportunity exists. Now, because this arbitrage opportunity only exists at extremely high speeds, an algorithm must be created to take advantage of it. Alright, so in order to create an algorithm like this one, there are going to be a few things that you will need. Number one, a computer program that can read current market prices at both exchanges and refreshes quickly. Number two, a price feed from both exchanges. These are usually purchased from the exchange and sometimes can even involve a direct line into the exchange for extremely fast speeds. Number three, an order placing mechanism that can route an order to the correct exchange. And four is the ability to backtest the trading system on historical price feeds. Now, due to the extremely competitive nature of algorithmic trading, sometimes setting up a high-frequency arbitrage strategy, such as the one we just discussed, can get very expensive and is not always guaranteed to work. Although algorithmic trading benefits the market by reducing human error, sometimes issues occur that just wouldn't normally happen during manual trading. This includes large market crashes that can happen in very short periods of time. An example of this is the flash crash of May 6, 2010 that caused the Dow Jones Industrial Average to drop 600 points in only 5 minutes. This was the biggest point decline on an intraday basis in Dow Jones Industrial history. Similar black swan events have occurred due to high-frequency trading, and sometimes the automated nature of high-frequency algorithms can increase market volatility. Alright, so now that we know the basics of algorithmic trading, it's time to talk to Scott Morris, the Chief Investment Strategist at Blackthorne Capital Management. Scott has a long history in algorithmic trading and even worked at Hull Trading back in the 1990s, which is one of the first firms to start to deploy algorithms into the options markets. All right, enough said. Let's get straight into my interview with Scott Morris. Enjoy. Hello, everybody, and welcome to another episode of Options Discovery. Today, we have Scott Morris, the Chief Strategy Officer at Blackthorne Capital. Scott, could you please introduce yourself and your background?
Sure, Alex. Thanks for having me. As you can see from the gray hair, I've been around quite some time. I grew up in the Midwest, and Chicago was my home for a very long time. So early on during college, I took a class on the derivatives market and kind of was hooked. And bulk of my career was in options, was at Whole Trading Company. I was there from 1990 until through the Goldman acquisition, and there until 2004. Currently, I work at Blackthorne Capital Management, as you mentioned. It's an alternative investment, a global macro hedge fund that trades futures, so all asset classes and futures. So it's a different application of quantitative modeling, which is sort of my main background, but it has some similarities to options.
That's really interesting. So you started your career at Whole. Whole was a big innovator back in the 90s when you started in terms of automated and algorithmic trading. Can you talk about how you kind of fell into that role and how you really got started in the options business?
Yeah, well, back then it was mainly floor trading. Almost all was floor trading, and you can't see my stature, but I was not the kind of person that would survive down in the pits. So having a computer and sort of doing some quantitative modeling kind of fit what I was doing. And so I got involved in the options. Whole Trading Company, as you mentioned, Blair Hull is an innovator, still is. Great guy. He always has new ideas and interesting things to say. But I got involved with that. And really, in the very, very beginning, it was sort of like, how do we connect information from different pits and use technology to do that? And then, the revolution with electronic trading happened first in Europe with the SOFEX, the old Swiss exchange, and I think it was 1998 when they went electronic, and then the DTB, the German exchange, followed after that. So it really picked up then. I was in Frankfurt for a while and had a lot of fun. I call it the Wild West of automated and algorithmic trading. That's kind of where it started.
Well, that's great. And so it really lends well to the theme of our episode today, which is going to be an intro to automated and algorithmic trading, which is something we've never really explored as a topic on the show before. So my first question is just for those of us that don't know, what is algorithmic trading and where is it used in the options industry today?
Yeah, I mean, algorithmic trading, also a lot of times called automated trading. It's just sort of using a computer program. It doesn't have to be a computer program, but a process that you apply in multiple ways. So it can be something very simple, where you have a program that calculates the fair value of the S&P 500 versus the cash, and then you kind of like trade based on that. Or it can be very complicated, like in options, you have a volatility surface where you have to calculate and extrapolate across all different strikes and all different terms and try to put those into a coherent box and a way to trade everything. Yeah, I'll stop there and wait for your next question.
No, that was a great response. And so, you talk about your experience at Hull, and as someone that was on the forefront of that automated trading back in the 90s, what's kind of the history behind where it was then and how it came to be what it is today? Because now automated trading is everywhere.
Yeah, I don't know how much time we have. It's just a fascinating history to me when you think about how far we've come. I mean, I got my first email address when I was in Germany, and it was 1993, I guess, and I was amazed that I could actually communicate with multiple people at the same time. And so we had an old DOS machine that when we were in Germany first. So I mentioned sort of like Frankfurt and Zurich, I guess, were the two places. The reason they did it, that they actually had an automatic electronic exchange and had a central limit order book that was matched, was because futures and options were illegal in those countries until probably about 1985. And they were kind of behind in the times, and they're like, okay, well, how are we going to compete with all these other countries that have all these established markets. Automated trading at that time was pretty cheap. So they said, well, we'll just do it computerized. And that's where it started. And then, algorithms were still pretty simple. I mean, we had this old DOS machine that would calculate fair value, and we'd have a surface curve that we put in there, and we were the what is the one-eyed man in the Valley of the Blind is king. And so we were kind of the only ones. Us and Timber Hill were there too, the two American firms that came over and were sort of the first ones to really exploit the electronic trading and simple algorithms. I mean, and there was like one guy that showed up that was like, teaming everybody. He would put his order one ticket ahead of everybody, which, that lasted a while. That was just a simple example of that. Ours were a little bit more complex. We always tried to incorporate risk into all of our forecasts. We tried to forecast implied volatility. You still, even the price of the underlying, you need to have a forecast model on that. All those were part of a complex algorithm that we use to try to price every option. And as a market maker, you just try to make a small edge on every trade, and then you use the law of large numbers that over time, if you have a small edge, that over time you can should be profitable.
Wow, that's really interesting, and I appreciate you giving us the overview of the history behind how electronic trading affected algorithmic trading and kind of those early systems that you worked on directly. So in terms of kind of the overall theme of this episode, let's talk about algorithmic trading in a more general sense. And how are ideas for algorithms discovered, and how do the creators of these algorithms start to find out what rules should be implemented or how to build this trading system?
Yeah, that's a great idea. A lot of times it starts with academic research, and there's a lot of good academic research out there. You need to look. Sometimes their data aren't so good, but you can get a seed of an idea, and then it's really important to have a rigorous back testing and cross validation process. I've seen so many people make rookie mistakes. One of my favorite stories is this guy who was a very smart physicist, world-class physicist. Someone to give him some data on some Latin American options market. I don't remember, it was Argentina or Mexico or something like that. And he came up with this groundbreaking model, but he clearly didn't understand the data. I mean, it was based on closing prices for an emerging market, and so the data weren't good. So that kind of broke down. So that was a rookie mistake. And other rookie mistakes, it's just thinking that you know more than the market, because you generally don't. The fact that you think that you can know more than the body of people doing it and come up with something groundbreaking. It's very rare. If you do it, good for you, but it's very rare. So to be a good financial engineer or quantitative modeler, you have to be skeptical. And if you come up with something that you think is really great, you're probably wrong. So that's where you start, and then you cross-validate, and you do back tests, and you try to make sure that what you created isn't just part of the sample, but actually can. If it worked yesterday and today, you've got to really, all you care about is that it works tomorrow.
That's great. And I saw that you mentioned back testing a lot. Can you explain a little bit more that process of back testing and evaluating a trading system?
Yeah, and talk about the evolution of the markets too. The fact that data are so much easier to get a hold of, and you really need good data, long history of data. Options markets are tough because if you have individual option data itself, well, what's at the money now could be away in a tail in 3 or 4 months from now. So you need to use techniques to sort of come up with an extrapolation of data, really a volatility curves, where you start with, we've got Spider Rock, you've got iVol, you've got a number of other companies now that have that data and have sort of put it in a format that's easier to look at. people always think about getting in a trade. They don't necessarily think about exiting a trade. So you've got to actually model both of them. So, the classic example is if you have enough data, you break it up into 3 time periods. Uh, you always leave, most of the time, you leave the most recent data to your pure out of sample. You don't touch that. And then you break the other part up into 2 sections. One you start with, and you kind of fit a model to, and then you test it and train it in a 2nd time period, and then you ultimately you make sure it works out of sample, and then we always incubate a strategy now for at least 6 months to make sure that the plumbing's right, and we didn't overfit it before we put it into production. So it's a process. Everybody always starts out with the S&P 500. I'm going to test this on the S&P 500. There's a lot of data there, but that's the most overmined market there is. So my recommendation, if you're looking at this stuff, start with something else. Start with some energy stocks or volatility of a sector like that, and tune your model on that. If it works for that, then cross-validate it on another sector. If it works there, then you're gaining confidence that you haven't overfit. And then, maybe you can try some of the index options and so forth. So it's a process of building confidence that with that skepticism that you're probably wrong, you probably overfit. But if you get enough evidence that supports your theory, then maybe it's an okay model. So.
Yeah, that's really interesting. And I like how you mentioned the continual process of kind of developing the initial idea from academic research and bringing it all the way through that back testing and those steps of skepticism to really evaluate, is this a good trading system? And so I guess the next logical step would be, how are these implemented? So now that you've found a system that you think works, you've back tested it, it's kind of run through all of your skepticism, all of your due diligence, how do we implement that and start trading with it?
Let me just add one thing about the research, and that is a lot of people are doing AI, artificial intelligence, and those sorts of things, where they have a different process, where they kind of are looking at like a window of a very short time period, maybe 3 months, and they sort of fit that and they kind of roll it forward. That's a different kind of research. People have been successful in that. That's not anything I have experience with. I will say that if you're new at research, it's really hard. It's very easy, let's say, it's to overfit the data, and so you really need to have a lot of experience if you're going to try to do that. As far as implementation of the model, to answer your question, you never really know until you put it into live trading, especially if you're talking about something like a market making algorithm, where you're actively putting bids and offers in the market. You're impacting the market through your activity. So but by definition, your back test is all of a sudden has a problem. So if you're trading like 10% of the volume of the market or something like that, clearly you just biased the results. And things like your execution assumptions. So a lot of people make simple assumptions about, well, I'm going to trade at the last trade price, or I'm going to try to trade at the end of the day. A lot of those things, and a lot of times those assumptions aren't necessarily correct. And so, for instance, even something as simple as using the midpoint of the bid and offer to do your trades. If your holding period is multiple days, and your edge per trade is a large number of ticks, then you're okay. But if you're talking about doing some kind of short-term, high-frequency trading, market making, anything like that, then those kind of assumptions are pretty critical. So you never really know until you put it into production. We have a section we call the incubator, where we try to replicate using a paper trading all the assumptions and sort of answer some of those questions. And then we put it in live production. And when we put it in live production, we always put it small and ramp it up, because you just don't know until it gets in there. And it's just a safer way to do it, and tried and true.
That was really interesting. And so how has this how have these algorithms changed the dynamics of the market, or have they changed the dynamics of the market by being introduced and increasing the amount of volume that they're doing?
I mean, yeah, the time horizon of trades has gotten a lot shorter. Milliseconds, right? So matter where they didn't before. When you're talking about even lines of communication from an office to a data center at an exchange. I mean, another interesting story. There was, it used to be that there was a quote reporter in the pit that was he worked for the exchange, and his job, or his or her job, was to basically input the quotes. Right, someone would quote a market, he'd put them in, and so forth and so on. And there was a researcher that noticed that this funny pattern happening, in like the S&P 500 over the holidays, and finally tracked it down, and it turned out that they had a different reporter there that was there, and I think he had some kind of dyslexia or something like that, so the prices were off. Something silly like that. But clearly in that environment, there's only so much when the prices are not real that you're basing your decisions on. They're close to real, but they're not exact. That impacts that. But so when you get this whole flow of data, and then so the time scales just shrunk, and which is good. It makes it easier for the rest of us that want to just trade normally, that the liquidity's there.
Yeah, that's really interesting, and it's interesting to see how the dynamics of the market have changed, not only through electronic trading, but through these algorithms providing that liquidity and that efficiency. And so, if you had to explain to someone that doesn't use algorithms to trade why it's important to understand their impact, what would you say to them?
Well, like I said, it's there underlying it. There's this other seedy aspect, which I'm not a big fan of payment for order flow. That someone is probably going to see your order, and if you're a retail customer, they're going to make a penny or two off you in doing that. So that's sort of like the one aspect of it, that the algorithms make that happen. But the benefit is that if they're there, then the liquidity is there across all different strikes and so forth. And it's easy if you're interested in it. It's easy to try them out. I mean, there's just like some momentum strategies on the underlying price, volatility trends, earnings. Look at the relationship between volatility if you're trading stock options around earnings, and the VIX is also there too. The VIX makes it easier to model, product on implied volatility. Just be careful that because of the asymmetry of the payoff there, that you can lose a lot of money if you're short the VIX, and because you have that unlimited upside that it can go in a very short period of time. So so there's a lot of opportunities out there to look into that sort of thing.
Well, that kind of leads me into my next question, which is people that are looking to get into the business or into the field of quantitative modeling or algorithmic trading. What are some important skills that they should focus on or try to develop?
Yeah, I mean, a lot of people fail at the raw data level. You have to have a good data set. You've got to understand your data and make sure you can trade on the data. A lot of academic articles fail there, and they draw assumptions that aren't real. And you can also have a situation where you can inadvertently peak and trade on something that already happened. So make sure you get some good data. Like I said, I mentioned two firms that have products where you can try data. I'm sure there's other ones out there in the options space. Focus on modeling implied volatility. That's the easiest thing to do. Not try to or the underlying price, right? You can options gives you the ability, instead of just trading a stock or a stock index, gives you the ability to fine tune your strategy, and it's also cheaper. It can be cheaper. So if you think even an algorithm based on accounting data, right? You could look at earnings on a company, or make a decision based on that, that's an algorithm as long as it's, has some kind of process to it. And then so you could do something like that, and then by applying options, a call spread. If you think it's going to go up, it's cheap. And a put spread, if you think the information is a negative on the price, it can be cheaper than actually trading the stock. And you're if you do the spread, then your loss is limited.
Well, that's really interesting, and I like how you put in the data analysis component and making sure that you have a proper level of skepticism so that you can make sure that your assumptions are properly challenged and that the due diligence is there. So when we think about somebody, let's say on the younger side, that's looking to break into the field of quantitative modeling, what would be a recommended path for them to start out?
Yeah, I mean, having some kind of computer programming or some kind of ability to deal with some kind of software to analyze it more than a spreadsheet. A spreadsheet is good initially, but you'll need something probably more than that. You'll probably want to create some kind of rudimentary trading strategy where you actually can back test data. Also, there's a lot of information out there. A lot of people are selling things or selling ideas or have academic ideas. Find one that makes sense and try to replicate it. That's the best way to start, right? So don't try to reinvent the wheel. Just someone. There's a lot of studies. We ran across one that was from an investment journal from 2004, and it talked about this process of I think this was actually different sectors of sector analysis. And back then they didn't really have maybe it was even before then, probably 1990s, they didn't really have the capacity to trade on anything than end-of-day data. But so you can take something like that and say, hey, this kind of worked there. Maybe I can try to trade this in the morning, or trade every hour or something like that. So start with a control. It's always good to have that control that you can go back to and first try to replicate it. Make sure that you understand it, and then you try to incrementally improve it. A good trading system is 1,000 incremental improvements. It's not necessarily one big aha moment. It's sort of like finding out these little things that get you to a path of getting a 0.5 sharp to a 1.5 sharp, or whatever your trading goals are.
All right, everybody, I just want to say thank you for watching this episode of Options Discovery, and thank you to Scott Morris for participating in this interview. All right, if you want to see the full interview with Scott Morris, that'll be available on all of our media channels as well. Other than that, I'll see you guys in the next video. Bye. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.